everyone, welcome to the next installment of Charts in Perspective, where we use charts to dive into the world of economics and financial markets. I'm Jennifer Nash, an economic and market research analyst for TMX Verify. Today we're diving into the performance of three key U.S. stock market barometers since their 2000 peaks: the broad-based S&P 500, the tech-heavy Nasdaq, and the blue-chip-focused Dow. While they often move in the same direction, their unique compositions and weighting methods lead to distinct performance. Over the past 2.5 decades, these major U.S. indexes have navigated market shifts, technological revolutions, and economic cycles. Now, we're going to explore how they've evolved since their turn of the millennium highs, using data through April 2025. Each index reached a relative peak in 2000. However, they occurred on different days. The Dow peaked on January 14th, the Nasdaq on March 10th, and then the S&P 500 on March 24th of 2000. So throughout this video, when I refer to an index, I'm using the start date as each individual's index respective 2000 peak. This first chart overlays the three indices using their nominal price, excluding dividends, beginning in 2000. As you can see, the indexes have generally moved together, but for much of the 21st century, the Dow, the green line, has had the largest growth, followed by the S&P 500 and then the Nasdaq. But the pandemic in 2020 marked a turning point. After that, the Nasdaq and the S&P 500 started growing at a faster rate than the Dow. This makes sense when you consider that the Nasdaq and the S&P 500 have a larger proportion of technology and growth companies, sectors that have seen strong performance since the pandemic, fueled in part by developments in AI. The latest trend shows another change. The Nasdaq, with its focus on technology, has started to lag behind the S&P 500 and Dow as economic uncertainty has grown in recent months. Now let's take a look at the same chart, but this time adjusting for inflation using the Consumer Price Index. The overall shape and direction of each index is very similar to the previous chart. The biggest difference is that the real growth in each index is significantly lower. For example, the S&P 500 has grown nearly 265% nominally since March 24, 2000. But after adjusting for inflation, that real growth is reduced to 95%. Similarly, the Dow's nominal growth of 247% goes down to 85% in real terms, and the Nasdaq's 246% nominal increase falls to just 85% after we adjust for inflation. Notice that we only started to see real positive growth starting around 2015 to 2018, depending on the index. Now we're going to shift gears a bit and examine the performance of three ETFs that are each designed to track one of our three indexes. The SPY ETF is designed to track the performance of the S&P 500. So if you had invested $1,000 in SPY back on March 24, 2000, what would that look like today? The total return has climbed to $5,668 for a compounded annual rate of 7.15%. But the real inflation-adjusted purchasing power of that $1,000 is just over $3,000 for a real compounded annual rate of 4.51%. Now let's consider the DIA ETF, tracking the Dow. What would a $1,000 investment on January 14, 2000 have grown to? Again, the total return looks better 25 years later, nearly at $6,000 for a compounded annual return of 7.31%. But the real purchasing power is practically half of that, at $3,138 for a real compounded annual return of 4.62%. And finally, let's look at the QQQ ETF, which follows the Nasdaq 100. Sidebar, we've been looking at the overall Nasdaq Composite Index throughout this video, but now we're shifting to the Nasdaq 100, which is a more focused index that tracks the 100 largest non-financial companies listed on the Nasdaq. The QQQ ETF is widely considered the most popular and most heard of ETF that provides exposure to a significant portion of the Nasdaq, so that's why I've chosen it rather than an ETF that tracks the broader composite index. Okay, so how would a $1,000 investment in the QQQ ETF on March 10, 2000 have fared? Your money would have grown to nearly $4,900 for a compounded annual return of 6.52%. However, the real purchasing power drops to $2,617 for a real compounded annual return of 3.90%. So, while the nominal growth of the S&P 500, Dow, and Nasdaq since their 2000 peak has been significant, the impact of inflation has substantially reduced the real returns for investors over the past 2+ decades. This highlights the crucial importance of considering inflation when evaluating long-term investment performance. Thank you for joining me on this installment of Charts in Perspective. For more economic and market insights, you can find my content regularly on the Advisor Perspectives website under the AP Chart section.